Hey guys, welcome back to the Capital Mindset Show. Sorry I'm a little bit late. I was receiving a package last minute. The guy showed up, had to sign for it and stuff. So yeah, I'm 7 minutes late. How terrible. So the reason why we're doing a live stream now is some of my audience, the time frames kind of messed up. So I'm trying to accommodate for everyone. And again, you guys voted for like 2 top days, and that was Tuesday, and I didn't get to do a Tuesday this week. Work was absolutely insane that day. So when life happens, I have to adapt. So yeah, so I think I don't know, I don't remember what I titled this live stream. I mean, it could be ask me anything. And yeah, we can talk about like what's going on in the market. To be honest, I have to even update myself on what is even going on right now because things are crazy here and there. And believe it or not, I actually don't look at the market every single day. I know the whole thing with Voyager occurred, and if you guys have questions about that, because that's yeah. I did cut my hair. It's pretty terrible because I cut it myself. So I cheaped out. Um, and I do it pretty sloppy if you ask me. But yeah, I'll probably go get it done professionally. Okay, so you're watching from work. Yeah, that's the way to do it. Yeah, so I guess my hair, yeah, it's pretty much just cut on the side. I was gonna shave the whole thing, but I decided not to. I chickened out. So I might as well go all out. So I probably should cut it. Um, yeah, so Dark Knight. So I do listen to you guys. I try to accommodate for everyone possible. So yeah. And yeah, the green screen's not behind me right now. So right now it's just the background, but yeah, I have the green screen over there to the side. But yeah, let's see actually what is Voyager doing today. And one thing I actually want to tell you guys is I might actually get the premium Zoom, so that way I can actually do live streams from there. And the way you can actually share your screen from that platform is a lot easier. Like I can do a lot more with it. Let me look at Voyager stock because I haven't actually briefed myself on what they're doing recently. All right, so they're up to $5.31, but they about 2.93% upside today. But over the last 5 days, still down 19%. And the Brooklyn. Okay, so Discord server will go up very soon, Spaceland. That's to answer this guy's question. And to answer your question, JP, no, Brooklyn, I'll do it if you guys want me to, but other than that, I'm probably not going to give attention to someone who would do what they did. But yeah, you guys let me know and I'll totally do it. I don't really care. Okay, so Voyager, yeah, they had that whole ordeal. I see that there's a lot of chatter on YouTube, which is absolutely hilarious because I was actually talking to Strongman. Strongman, if you're up there, we weren't talking, but I sent him some things that were really funny. It was a couple of videos made by a particular YouTuber, about a year ago or so, and the funniest things were being said at that time. And I hadn't seen those videos until recently because I just thought it was curious, like, oh, what did that person say? I'll give this person credit. They didn't delete those videos. So credit where credit is due. They're owning it and they're keeping it up there for the time being. If they do delete it, I'll change my mind. But yeah, it's really interesting to see in hindsight what the assumptions were made by that individual. Of course, the price targets made by that individual were, I think, pulled out of a hat. I don't know on what basis they were. Yeah. Oh, you thought he pulled up to my house? That would be so funny. I mean, I don't know how he'd get through everything, but yeah, that'd be really funny. He had to like trick me into letting him in. Oh, I didn't even know WBA dropped. You see, like I don't pay attention to every single stock all the time. For example, one of you guys actually notified me that Stitch Fix, which I made a video about Stitch Fix a while ago, and I forgot what it was trading at, but you can look at the video in which I talk about it. It was trading at a much higher price, and I said that there was like a price target of about $11 that I personally thought, and I rarely ever say that. I don't believe in like providing price targets like that, but it actually hit under $11, and a subscriber actually messaged me and asked me to just say, hey, thank you for that insight. And I thought I was going to do maybe like another video on update on Stitch Fix. But let me actually take a look at Walgreens. So Walgreens is just okay. It's down like 5%. I'd have to take a look at exactly what the heck is going on. Yeah, it's pandemic demand. So I was already out of Walgreens. Um, but yeah, one stock that I'll say that I actually, well, I don't regret it because of what I put it into, but my Bristol Myers holding, I had sold on the pop to about 61. And I made a video about that, and I remember there was like mixed feelings about it, and so there were some questions as to like, okay, but what did you buy instead? And well, that mainly went into the commodity play, so I don't really regret the move. The move ended up being a good decision in hindsight, but that's a company that I did sell, and then it actually did roar up. But again, we have multiple reasons as to why we sell things. But yeah, going back to Walgreens, yeah, I expect something like that to happen. We also have to be careful or cautious about what Amazon is doing in that category. There was a lot of fears that they'd go after something like Cardinal Health or McKesson, but now it seems like what they're really targeting is more the Walgreens and the CVSs. All right, so I got some questions here. Ooh, well, okay. So I see. I'm sorry. I'm gonna try to catch up here. Yeah, Tattooed Chef. What I'm gonna do is I'm actually gonna create a portfolio position that's gonna be called YouTube stocks, and then in that portfolio, I'm gonna weight it in a certain way or a certain capacity. I'm gonna weight. I'm gonna put in there all the YouTube stocks that are very popular, and then count it as one position and just put it in the speculative side of the portfolio just for fun. And it's gonna be a negligible portion, but heck, it'll be fun. All right. Okay, so hey, no problem, Bradley. All right, so hey, Fabio, thanks for the live stream. Have you seen UiPath recently? I really like their story, story investing in speculative nature. Yeah, okay, good. That's good that you know that though, on just that. And their fundamentals are improving, not a cash cow though. Well, I mean, I'd have to really take a look at them, but which I haven't done in depth. But yeah, it's okay that they're not a cash cow. It's the prospects that they will one day be cash flow positive, and then by how much, and then how long will they continue that growth going forward. So, it depends on if you have specific inside knowledge, not inside knowledge, but specific knowledge that puts you ahead of the curve in terms of understanding that business. So, yes, Stitch Fix, I have to do the other video, or I guess an update video on that one for you guys. And yeah, we see Walgreens coming down, and then Voyager again. If you guys have questions about Voyager, it's really interesting stuff on the legality of it, what they're doing, and they're fighting each other, them and the government. They're like, oh, that's a securities, and then they're like, no, that's not securities, but they are saying the words or using the words investment, growing wealth, and stuff like that, which makes it seem like it is. And that's how the government's going back and forth. When I get into the reason why I haven't done a video on Voyager yet is because I was avoiding doing so until I could possibly explain in a good way all the individual crypto assets that they hold, because I don't think there's a lot of content on YouTube. There's some content explaining like the different crypto assets. Like for example, the Anchor protocol. A lot of people don't explain what the Anchor protocol is in a easy to understand way. So I've seen some videos that break down the Anchor protocol in a more complicated way. Like it's not for the average investor just coming in and just saying like, what the heck is the Anchor protocol, and they don't break it down. So I'm going to try to do my best in doing that, and then do Voyager and then Coinbase analysis, and then kind of all that culminates into one larger video, but in separate videos. You need my signature? I mean, if I ever see anyone in public, you really want my signature. I don't know why you want my signature, but if you really wanted me, why not? No hesitation there. Okay, thoughts on portfolio allocation. Oh, and I don't want to skip anyone's questions. So, do you include debt and cash in your valuation when you evaluate stocks? Yeah, I mean that's included in the enterprise value. When you calculate enterprise value, you're removing all those factors, right? So you're adding debt and you're subtracting cash. All right, thoughts on portfolio allocation. Would you recommend active / passive mix of both? That depends on the investor. You got to be first, number one, honest with yourself in terms of your own capabilities or your own belief in your own capabilities. So if you are someone who, first of all, just wants to focus on increasing your income, and you don't really want to be bothered with the whole researching companies and stuff, absolutely just index funds. And then if you want to not use index funds, you got to be really honest with yourself if it's something you're willing to go into in terms of really putting in the work that it takes to perform very well. So maybe a mix of both is probably best for newer investors as they're kind of figure things out. And then a lot of investors will over time realize that they should have just stuck to the passive strategy in the first place. But there's no harm in just like figuring it out on your own. I'm not opposed to people figuring it out. Sometimes we can tell people something, and then sometimes people have to learn things for themselves. Okay, so well, you guys are so funny with your comments. I'm trying to get through all of them. Uh, Wall Street Bets Alliance, that's really good. Underrated comment. All right, so uh, yeah, I mean, hopefully there's other people that make content on the individual structures. Like for example, when I eventually get to doing the Dutch Bros video, the Dutch Bros is another VIE for those of you who didn't know. VIE, variable interest entity. We've covered Chinese VIEs, American VIEs, British VIEs. Dutch Bros is another VIE. I just actually took a look at another one. Starwood Property Trust has structures of VIEs within it, but not necessarily exactly a VIE. Okay, so well, the average growth rate actually just takes into account the average growth rate over the measured time period. So quite literally, it takes the average compound annual growth rate, but within the measured time period. So you use the compound annual growth rate formula and you solve for R. Yeah, I've heard of him. Everyone's heard of him. Yeah, he has classes on valuation on YouTube for free. Yeah, okay, then that's fantastic. See, that's what I like that YouTube is providing. YouTube is such a great space to learn a lot of information. So here you guys go. Andrew Austin is letting us know he has a whole class of valuation for free out there. I mean, it's good to take it, and then why not take more information? The more information, the better, in my opinion. Okay, so home builders at this time. The thing is, I think that there is a potential, not a potential, there's a strong belief that I have that there possibly is a lot of overbuilding going on to meet the excess demand. A lot of these home builders know and understand that there's a lot of this pent up demand in the market. So they're trying to meet that demand so they can extract profit, right? So with that being said, we know that home builders are a cyclical industry. I just think that they might overbuild and they look cheap right now. And the reason why they look so cheap is that the market is kind of pricing in that cyclicality factor. But yeah. Okay, so Spencer, this is actually a really good question because this is a question about having the art and a science. So there's the science aspect of investing, and then there's the art aspect of investing, the feel that you get. So basically how I do it is I have to first like what I'm investing in. If I don't like what I'm investing in, the reason why I would avoid it is because then there's a higher propensity that I'm going to sell it at the wrong moment, because I'm human and we're all human, and we all are subject to our limitations in psychology, so our minds. And if I don't know what the heck it is that I own, I am far more likely in a downturn to sell that asset, and far less likely to understand when I should buy it and not be afraid when everyone else is afraid. And then on top of that, so I take that, and then on top of that, I do a quantitative analysis to figure out, is it currently at a fair price? And that's supposed to help me remove those same emotions as to the story, because the story aspect is going to stir up emotions that I'm excited. And then the quantitative aspect is supposed to tamper those emotions so I don't make an overly emotional decision in terms of purchasing an asset. Okay. Yeah, that's the only way I give signatures on blank checks. Otherwise, no, I would never do it otherwise. Yeah, so this is actually a good question about the yield curve inverting. So the yield curve has to have a sustained inversion before we can consider it a predictor of a recession. So if it's a sustained inversion, then I would start to, say that, yeah, probably one's going to happen. But, just aside from the yield curve inverting, you can kind of look at it. We've been talking about this for a while. So we had the liquidity crunch that we're kind of like quasi exiting, but not really. But you also have to consider this conflict has escalated another problem, which is oil prices. So if oil prices stay high, that squeezes the consumer, which draws down consumption, which then draws down, the economy, because the largest part of the United States is GDP measure is consumption. So we got to hear a direct question on a stock. Hey, Fabio, what are your opinions on TTCF delaying earnings? I remember my friend saying something about TTCF moving COGS into operating expenses, but I'm not entirely sure if that's true. Well, no, they did some amendments, and we did take a look at that last year, and they were just a new company, so a lot of the rules weren't really applied to them at the present moment, and they were talking about that in their 10K, and then they went back and amended, and I think in one of the videos we talked about there was a change going on in December. and it had to do with that. And they were actually talking about that. But um, what is this? Do you include debt and cash in your valuation when you Yes, I do for some aspects. You have to be very specific on that question. Oh, you have a second part. What I meant was when you do cash flow and revenue projections, do you add the cash to the cash flows and subtract debt or no? Well, specifically, what are you trying to do with that? Are you trying to create a multiple, like a terminal multiple approach? If you're doing a terminal multiple approach, I don't know what like I mean is, you do cash flows and revenue projections, do you add the cash to the cash flows, subtract the debt? Oh, okay. You mean like basically using enterprise value to some degree? Well, I do use enterprise value as like a metric, but not necessarily. No, it depends on. It really depends on the business I'm really looking at. Um, okay, so I've seen some questions about Discovery. I hope this answers all of them at the same time. If you can look at Discovery news about the mergers, news about the Discovery CEO get paid too much because his stock is down a lot these days. Yeah, I mean, that's true. I've heard a lot about that. I've heard a lot of discussion about the Discovery CEO being paid a lot of money, maybe not as much as deserved. There was similar talk about Activision, and when I was getting into Activision at the time, I had to analyze that per se, and it's not really that much of a concern outright in isolation, but it is a concern if the company is severely underperforming in terms of actual business metrics, because then it's basically saying you're basically paying for some chump to run the company, and you don't really want to be in that position. Because remember, you are the owner of that business. If that company is not running itself well, if that company is squandering your resources, your money at the end of the day, why would you be involved with that? So I sold Intel, but I might get back into Intel at some point. But I sold Intel because I didn't agree in how they were allocating capital, particularly how they were raising capital to invest. I did agree with the investment. I disagreed with how they acquired the capital. So I sold. There's nothing wrong with that. If you don't agree with how a company is being run, we shouldn't invest in it. That goes back to the story. You have to like the story. Okay, so there are a lot of questions, guys. So I have to go through these. So thoughts on real estate correction/crash. I'm in Canada, so it's a whole another level. Yeah, you're Canadian, man. Oh, uh, so yeah, I think that if we see a lot of overbuilding, which I do think that there is in the markets, kind of telling us that with how they're pricing home builders, that there might be like a cyclical downturn with homes coming. If it wasn't, they wouldn't be pricing the home builder so cheaply, right? And it's cheap for a reason. Okay, so but like kind of combining the two together, if we see, for example, rates rising and a lot of supply coming online that otherwise wasn't there, and I don't know about the Canadian market, but that would be a recipe for home prices to come down quite, not drastically. We're not talking about 2008 levels, but we're talking about decently, something that just a little bit, just a little bit. No, you are not blocked. You are not blocked. I can see you. You're the zeros and ones. Okay. I do invest in REITs. I'll tell you some that I like personally because of their model. I like Vici Properties and I like MPW as business models, because I like REITs that focus on. Of course, you have Realty Income Delaware, which is like the creme de la creme. You have Agree Realty, which is one of my good friends, his favorite REIT. And but yeah, Vici and MPW, what I like is that they hold assets that are vital, that they have tenants that aren't really going to leave. For example, Vici owns Caesar's Palace. Can Caesar's Palace operate anywhere else and call itself Caesar's Palace, right? So it's a double-edged sword, right? Because at the same time, if the tenant does leave, there's a lot of money that has to go into the property to retrofit it for someone else. What else can you put inside Caesar Palace besides Caesar Palace or the Venetian? What else can you put inside that thing? So it's a double-edged sword. It's a benefit because the Venetian as a company, as an operator, won't really go anywhere else because it's got to rebuild the Venetian. So I have no idea when Gazprom's opening. And to answer this question, Google's my top holding as this individual stock. But technically, all the companies that I own in my portfolio, I am bullish on with a 10-year outlook. Most of them are acquired. The more recent ones that I'm acquiring with definitely the 10-year outlook is Netflix, Meta. I almost said Facebook. Facebook's been the one that it's been a little sad because it was coming down and I was adding all the way down and increasing that position, but then it rose up and then I kind of had to slow that down. But yeah, Alphabet, Meta, Amazon's in there still, but Amazon obviously, And yeah, Netflix. Basically, all the companies I am adding, I do believe in on a 10-year outlook. So I say all of them. Luna. Well, Luna is going to get its own explanation because that's getting into the Anchor protocol and getting into Terra and all that. I will do a video on that because it's really interesting stuff in terms of how they were designed. Thoughts on investing if there's a positive price action trend, something like Drunken Miller did. You mean like momentum investing? That's my question to you. Okay, so the course will take a lot of time because when I'm going to do the course, it's going to be a fully fleshed out course, not just some series of videos. So I hope you guys understand that it's not going to be like, well, I've talked to other people who they had other YouTubers courses, and from my understanding, the other YouTubers courses is simply literally just a set of videos, which is really funny because based on the price, they charge basically the equivalent of a college class at a public university for these courses, if not more at times. And so I think it's kind of funny because I think you need like some real practice, so like real world problems and stuff like that, case studies, stuff like that, with supplemental videos. So I'm gonna have like some sort of way of getting like files in there and maybe like PDFs or like a Google Doc. And then it's like you click on the link, you get a copy of it, stuff like that, and you work through stuff like on a Google Sheet. But yeah, that's how I'm going to be basically designing it, and then supplemental video information. So that it's going to take me a while, and I'm going to be doing 3 of them. I'm going to be doing a personal finance, which is like like credit cards, debts, loans, and stuff like that. Not getting into like specific securities or instrument recommendations because it's not personal finance financial advice, but personal finance, like how to balance certain things for like students, young people, and if adults want it too. There you go. And then one that's about finance, and then one that's about accounting. The accounting one's going to be the hardest one. Okay, so Europe. I mean, Europe is a slow-growing market. The thing is, Europe, we want to look in Europe for companies that are global companies. So that's kind of like a theme that I look for. So within Europe, it's more difficult for me to find smaller businesses that are expanding and that show promise. But it's easier to find if you're an international investor. It's easier to find the international companies. You're going to get them at a later stage because they won't really show that they're international companies until that later stage, but that's perfectly fine. So with Europe, I like to try to find those international companies because if they're just a European company and they're already kind of in that mature phase that I'm able to spot them fairly easily, it's very difficult because Europe is a slow growth market. They have their own problems. Europe has their own problems. The U.S. markets aren't reaching that problem yet. There's still a lot of pump left to go in the United States for the foreseeable future, maybe my entire lifetime. But yes, Europe is kind of on the other end of the curve in that sense. United States has a lot of advantages over Europe in that sense. And then American companies are basically global companies. That's why I tell people it's like, you want international exposure. Look at American companies. Like Procter and Gamble sells everywhere in the world. Clorox, same thing. A lot of these companies, Apple, you telling me Apple's an American company at this point? It's an international company. Same with Alphabet, Meta. These are all global businesses. They're no longer just American businesses per se. Okay, so yeah, I'm getting a ton of comments. Here we go. So questions about stock market going down. Well, the stock market may continue to fall, may not continue to fall. Who knows? Focusing on that would be, I think, redundant. I think what everyone should focus on is acquiring good assets, whatever it is for you. Okay, so I won't tell you what is a good asset. You figure it out what is a good asset for yourself, and then just buy good assets, and then don't worry about what really the market's doing. Focus on what it's producing. The cliche of the farm story, like focus on owning your farm and what your farm produces. Don't worry about what someone asks you what your farm is worth. Just buy the farm. No, I haven't talked about Bank of China. So Bank of China, if we take a look, let me see. The thing with Bank of China, I think that's the state-owned entity, right? So Bank of China, yeah, it's trading at 39 cents USD, and this is their, I think this is their ADR. Well, it's an OTC. So, I mean, this thing has such low volume. This is probably just quite literally a cash cow. I don't see any form of uh, payments coming out of it. But I are you in the Asian jurisdiction, Zach? Is that what you're asking about BOC? All right. Okay, Spaceland. You came for blood. No, I'm kidding. Bobby, please go into how everything money said, including dividends and buybacks, is double counting and settle this once and for all. Don't worry, Martin. I'm not roasting you. It's misinformation. Oh, did Martin say something about that? I sorry, I didn't mean to ignore you, Martin. I'll try to find your question, Martin. Okay, so here's the original question, and Spaceline is not roasting you, but simply put, where's your question? Yeah, simply put, oh no, yeah, this was a response to him. If you're double counting it, what you're basically doing is you're implying, and I'm trying to say this in a way that also doesn't like show like how to do it, but because if they don't know how to do it, I don't know what to tell them. But maybe they skipped math or something like that. But anyways, regardless, let me stop ripping on them and just be serious with it. So when you're double counting, it's because you're doing it as a percentage of the actual cash flows themselves. And then when you're doing it like that, or you're counting it as the cash flows in and of itself, yeah, you're going to be double counting. So when you include dividends and buybacks, you're going to count it twice. But look, I'll just say this: it's just algebra. It's just a set of algebraic functions, and then you can come to a conclusion or a calculation that shows the effect of buybacks over time. I've seen actually other people create models as well on YouTube that does it successfully, but if they can't do it, then I don't really know what to tell you at that point. I really don't. Uh, it's not overly complicated, right? It's not overly complicated. I think you need, in terms of knowledge skills, you need college algebra as a course and actually understand what you learned in college algebra, and basic finance or accounting, because you just need to know what shares are and stuff. But yeah, that's really the math. It's not calculus. All right, so I get some. All right, we got a Boston Omaha. I'll have to look at Boston Omaha. Palantir. Okay, fine. I'll talk about Palantir. So Palantir, like I said, currently technology is currently unrivaled. The question then becomes, what is the value that we're willing to pay for it? I've had my flirt with Palantir in the past. We had a little love story, and it was a good love story, and it turned out well. And then, I mean, if I get back in now, I'm still way below where my all my sales prices were. Even my last itty bit of sales, I think was around 19. So it's in the video. You can see like the screenshots. So I forget what price it was. I don't have that memorized. But yeah, Palantir or Palantir. I always pronounce it wrong. My only concerns, and you see that we have all this like hype or whatever because Google is like partnering with them. It's like not really, but like yes, kind of. And they're getting all these partnerships. My only concern is like how long will that last? Their positioning. So I have Google in the portfolio. If I added Palantir in the portfolio, it wouldn't really matter. I would add Palantir again back to the not necessarily speculative bucket, because I don't think of them as something that has to show its potential. It's showing it. What becomes a concern with something like Palantir is keeping its position. It has the position, and currently it has the right to win. It's just whether or not they can maintain that position is the a driving factor that actually makes it so it distinguishes it between a speculation and an actual investment. So I think that there is a high likelihood that they do keep it, but we'd have to see. All right. How do you invest? How do you invest in bonds of distressed companies as a retail investor like Howard Marks did? Well, no, it's a little more difficult because you're not an institutional investor. So Howard Marks has, I mean, that's his whole business. I mean, you can try to find if your broker can sell you these bonds. Your broker should have bond trading as well, and then basically you have to find bonds that you think are like a financial position of a company is very bad at the present moment. It looks really bad. So then you think the bonds are trading at a discount, and then you buy, and it turns out that the financial position of that company wasn't so bad and things would improve. For one of them that I remember explicitly was Hersha Hospitality, was one that we got involved in. and we bought the bonds for like pennies on the dollar during the and again we made a deal through the through some brokers, but the point is we acquired some of those bonds, and not me personally. It wasn't my personal account. It's the company account. So we bought Hershey Hospitality bonds, and then turns out that the pandemic wouldn't have bankrupted them, and so they didn't go through bankruptcy, and we're in the clear, and then we've actually already sold that position. But yeah, stuff like that. I'm so angry. I see MMM, CAA. Oh yeah, okay. So I use MMM and CAH products daily at work. You work at a hospital. They sell products that are not going away anytime soon. Yes, I completely agree with that. Cardinal Health, that was a lot of the thesis was it was a distressed asset, an asset that is not going anywhere. It's vital to the current system, and so uh, we we bought Cardinal Health, and we're up like 20 something percent. I haven't checked its price yet. Again, like I don't stress myself by looking at the market every day. I kind of just let it go. Um, when they sleep, I beat. I don't know what that means. But um, ah okay. So I got some. So BOC Boston Omaha, not China Bank. Okay, so Boston Omaha. Well, I'll have to take a look at specifically what's been reported. I haven't seen what Boston Omaha reported. Any thoughts on Putin trying tying the ruble to gold and renouncing the petrodollar? Okay, so this is the concern I stated in the Strongman Personal Finance live stream. But this is a greater, like this is like kind of like the greater overarching war going on within the West and something like China. China knows that it doesn't have to actually defeat the United States in like a hot war. It just has to defeat the United States in sort of a monetary war. And like they say, your greatest strength is also your greatest weakness. Well, the United States' greatest strength is military and currency. So if you can eliminate the currency, the military pretty much kind of goes with it because it relies on the strength of the dollar in order to spend and use resources. And so the currency is the primary strength, and the secondary strength is military. And coming with the world reserve currency and financial power, you get military strength. So you need like one to have the other in a lot of ways. So China's whole shenanigans dating back since I think 2011 is that they've been really active in trying, and this is like decades long plan. So if you kind of see where they're trying to spread their influence, it's mainly in resource rich nations that are somewhat adverse to the United States. So you think Latin America, Belt and Road Initiative in Middle East, and now you got Russia. Russia's kind of like being pushed to the final straw with regards to trusting the United States in any form of capacity. And then you got Iran. Saudi Arabia is using it as leverage right now. It's no coincidence, is what I'm trying to say, that Saudi Arabia is using this as leverage and saying to the United States, hey, you got to be a little nicer to us, otherwise we'll go join this team. And in this team, it's not a hot war. It's just we don't recognize the dollars as we once did, and then that can severely harm the United States in another capacity without firing a single shot. No shot has to be fired. No one has to necessarily die. Yes. Lots of people. Okay, so lots of people choose not to work at Facebook based on statistics. Is this a concern for you? No, not really. The whole like they don't choose to work at Facebook, I'm assuming it's because culture and whatever, and that can change for the most part, but paycheck's a paycheck. So what I'd have to see is something changing in the power structure of the business. If the power structure of the business changes, and what I mean by that is like the power in the relationship with the consumers and the world, etc. If that starts to change, then the story around Facebook does change, of course. We are seeing right now, I think the more recent concerns was, their power structure in relation to Google, in relation to Apple, who's really in control in that capacity. Well, Google controls the consumers and so does Apple. So with that being said, Facebook's in a troubled relationship with them and has to balance out, making sure that they're happy with them. So that was the concern more recently. So if that changes very drastically to the negative, that would be a big concern for me. Okay. Oh, this is a comment to what I was saying. I don't know where he is, and I also don't know where it the other individual is. I haven't seen any videos, and I'm kind of upset because I'm their biggest fan. Good morning. Well, over here it's afternoon, but good morning to you, sir. Okay. I am BP's only subscriber. All right, so that's good to know you work at a hospital, Dark Knight. So then I'm gonna be asking you all the questions hospital related in terms of what products you see there, if you can answer any of those questions in the future. All right, so I'm taking a beating because Barclays. Do you think there would be a Okay, so I have to take a look at Walgreens again because I'm getting a lot of questions about Walgreens. So I'll have to take a look at Walgreens in isolation and try to figure that out because I have to reevaluate the business. And let me just get this text message here because this is a work-related text message. It's supposed to be my break, but you know. All right, so let's go. Where's Small Gabriel? I don't know where Small Gabriel is, but yeah, I'd have to take a look at Walgreens, specifically what's going on right now. The videos I'm gonna actually focus on bringing out more recently. I already filmed this one, but there's a video coming out on context logic. I filmed that video because the stock was up when I filmed it, which was yesterday, and it's easier to. I like to film a video if it's gonna be a negative video when a stock is going up, not down. And now it's down today. So when it comes out today, it was filmed when the stock was up. So yeah, not when it's down because it's easy to kick it when it's down. All right, so I think CVS is better in my opinion. Yeah, okay. So here's like the basic bull thesis surrounding with CVS. So CVS is trying to vertically integrate a lot of different services, and so is Walgreens now with like Med MD or Village Med, something like that. And CVS they purchased an insurer. So there's an added benefit, and then there's also a drawback. The drawback is the risk. But here's the thing: when rates rise, and I've said this in other live streams before, when rates rise, you think banks are the better option. But no, it's actually insurance companies. And so I have an insurance play that's Unum Group, or yeah, Unum. And Unum is constantly always trading at below book value. So, you know, it looks on paper like it's a screaming buy all the time. And I think the book value is like $50 a share, and it's trading right now like $30. And I bought it for like, I think 18 something or something like that. So, with regards to CVS, they now have an insurance arm. And so, with rising rates, that should actually be really good for CVS. So, yeah. Okay, why do you think Amazon is a threat to Walgreens Boots Alliance? Does market think 60 to 80-year-olds will be ordering medicines slash vaccinations online? No, 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 no. But prescriptions filling, yeah, to some degree. It's the fact that it's a mature market already. I mean, it's going to continue to grow a little bit because we still have the retirement boom. And so that business is going to continue to grow. Walgreens, what they can offer is convenience that you go to the place. But if it's a routine prescription fill, it's very easy to just to go to Amazon. And it's not that Amazon. The thing is, you're fighting with someone who doesn't need the business. Okay, that's the danger here. So with Amazon, it's someone who doesn't need the business, and then for the other guy, it's their bread and butter. So if Amazon takes, let's say, 15% of the market, 20% of the market. So there's still a minority of the market, but that's 20% that's not going to Walgreens and CVS. Okay. So that's why what they're maybe being priced for. Okay. So the market might be pricing that in, and that's why they look really cheap because Amazon's going to come in and let's say they only take 10%. Well, that's 10% that's not going to Amazon. Sorry, not Amazon, Walgreens and CVS that was taken from them. And again, that's not Amazon's bread and butter. Amazon doesn't care really. It's not really affecting the business. This is added business that Amazon is doing. So that's the little bit of the problem. So my course will not be on Udemy. It will just be on YouTube. And so it's the easiest way to make it completely free, pay what you want, because that's the model that it's going to adopt. So anyone can really do it. And if someone is, they don't have the money at all, it doesn't like prevent them from learning. And the goal is as many people as possible. And of course it'll be ad supported and stuff, but the ad money is going to be like bleh. But it's going to be just like a little passion project. It'll be on YouTube. And then how I'm thinking about doing is having like documents, like Google Docs or Google Sheets listed in the description section, and that'll be like homework and stuff like that. So it's pretty easy to set it up that way. And then also it's very easy to access. Anyone can access it. All right. So how much cash do you currently have percentage wise? Is this liquidity crunch still a concern for you? I mean, it's not like a concern where I like time the market. It's something that I observe, and then I might change my assumptions into the valuations of stocks, but it doesn't mean like I go, oh, liquidity crunch is happening, I'm selling this portion of my portfolio. No, not at all. And I actually want to be clear by that, because some people might perceive it that that's what I mean by that. And no. So when I think there's a liquidity or crunch on the horizon, or it's occurring, it may prevent me, for example, from buying some stocks that may be affected by that. All right. So then, or I might consider in my projections in current holdings that the value has changed in some capacity. So one was the banks. So all the banks kind of got taken out. Some of the REITs, not some of the REITs, all the REITs got taken out. And I just secured those profits and then redeployed that capital elsewhere. And currently, in terms of percentage of my portfolio, but the thing is, I have to be like careful how I really say that. It's because I count my cash as just like my cash for my total. And, there's many reasons to hold cash. There's emergency fund. There's, you got to have enough money to always make sure the mortgage is paid and you can last for years paying the mortgage. And as well as, real estate, invest in real estate. So you want to, there's many reasons why someone might hold cash. So if you look at it, I think it's probably in terms of like net worth, like 40 or 30% right now, something like that. But yeah, I don't actually just, oh, I'm selling my assets because liquidity crunch, or, oh, I'm going to buy a lot because I think there's like a reflation or something, All right. So in one of your previous videos, some month ago, you were talking about Alteryx. Is it a business you are following? Yeah, it is a business I'm following. So they're trading at 9 times sales, while compared D-Dog is trading at 48 times sales. All right. But you got to understand like the main differences, the primary differences between Alteryx and Datadog. So Alteryx is it's technically supposed to be a low code data analytics platform, similar to something like Tableau, and it's supposed to do the full stack of data analytics. So the thing with Alteryx is their growth actually slowed, and I think Datadog's growth has not slowed. So when you look at the sales multiple, and you're using it properly, by the way, because sales multiple in isolation, I don't know why people do that, but you're supposed to use a sales multiple as a comparative measure, and that's about it, and not simply in isolation as a valuation metric. Some people use it as a valuation metric. I don't know what to say to that, but as a comparative measure, which is what you're doing here, I see the logic or the understanding behind it. And Alteryx is, yes, trading at a cheaper sales multiple, but also it's growing a lot less. I think right now it's projected to grow like 20%, but the sales like just completely died off. It was growing at one point over 100%, and then it just completely fell off the cliff. And that's again why you saw that correction. Now, the thing with Datadog and Alteryx and all these businesses is it's so quick for them to change. It seems like it's so rapid, the change. There's always a new competitor coming out that's always better in some way. And then who has really the power? Well, the power lies with the client, and the client wants to have the cheapest and the best. So you're always fighting for lower and lower costs. So it makes it very difficult to raise price. You got to find a business, a software, if anything, that is basically integral to your business, where it's the switching costs are so drastic. So Alteryx, Tableau, and all these, they're not really that difficult to switch out, because, like, let's say who really has the high switching cost is Microsoft. In this instance, like you get Azure, Microsoft Power BI, but Excel, right? A lot of these files that you can shove into Tableau and Alteryx are Excel files. So the core software that you really need is Excel. And then I don't know if Google Sheets has those capabilities to shove it in, but I assume that was designed by Alteryx. I haven't checked, but Alteryx probably might have a way for you to shove a Google Sheet in there, but you can very easily shove an Excel file into Tableau and Alteryx and all these other companies. So that's what you kind of have, I think about. And so Datadog, Alteryx, yeah, they're all great and good. They do all these wonderful things, but the next guy is always coming along and he wants to take your money, or he wants to take your customers away. And your customer is very price sensitive and also sensitive to performance, right? If they have, something better and it's not really, the switching costs aren't that crazy, they're going to switch. Okay. Which is a problem. And then, like, think of like AWS. AWS has high switching costs. Extraordinary amount of money has to go into that business in order to replicate that business. Look, like, who's the competitor that came into the market? Microsoft, right? Microsoft had a huge war chest. Of course they can come in. And then Alphabet. And you had Oracle. You have a couple others, IBM. Like, yeah. Sure. But you have all these other guys that come in, and they're nothing in terms of the relative size or strength when compared to something like Alteryx, right? Alteryx is like a little minnow, and then AWS is like the bedrock, and switching out of that thing is, costly. Switching out of all those is costly. Okay. WBA, it's ABC, Amerisource Bergen. But yes, they do. And that they have a closer relationship with them. Cardinal Health does a lot of business with CVS. I know you didn't ask that, but I'm just letting you know as well. I'm just vomiting that on you. All right. So, how many years of analysis do you use on your model? Well, the model is actually capable of any year from 2 to 10. Currently, I can go further, but I don't feel like the need to. But I've programmed it so the user indicates how long they want the model to go for, and then it adjusts everything automatically. So if you want to do a 2-year, 3-year, 4-year, 5-year, 6-year, 7-year, 8-year, 9-year, 10-year, all possible, and it adjusts everything. Just as I've added new features such as adjusting for anomalies, adjusting for financial stocks. I'm still working on the final adjustment for like REITs, but that will be in there. And then specific adjustments for MLPs. That's going to be like the last thing I add, because I hate MLPs. I hate them. Hate them. Hate them so much. Anyways. No, I don't hate all of them. I don't hate all of them. Now I'm probably going to get a question like, why do you hate MLPs? But I don't hate all of them. I'm sorry. I clicked on that question and then I stopped. All right. Hold on. Give me a second. I got to. This is what I get for doing it in the middle of the day, but I'm doing it for the viewers that are in a different time zone. Okay. Sorry. Now we should be good for the rest of this live stream. All right, cool. Sorry about that, guys. All right, so just curious, which subscriber request stocks are you planning on doing next? All right, let me actually pull up the list and I'll tell you. So I've been getting quite a few, and then the one that is next is okay. Well, Coin and Voyager was already at the top, but I already discussed like why I'm kind of holding off on those two. There's Take Two Interactive. There's actually for Nubank, a Brazilian company. There's also ticker symbol UIS. There's a ticker symbol, well, Ollie, whatever. This the discount store Ollie. I can't remember the full name. There was a Tupperware versus Newell Brands request, and I also have a Voxture request, which is more of a micro cap. So I'm kind of questioning on that one. Everyone can look in on that one on their own. Maybe if I don't end up doing a video on that ticker symbol, well, I don't know what the ticker symbol is. I just wrote Voxture. It was a request by a subscriber, and yeah, hesitation on that one because it's a penny stock and a micro cap. What else? Beyond Meat as well. Beyond Meat, Beatrice. Those are some that are there. Hopefully that answered your question there. Okay, so thoughts on strongman dismissing dividends, saying you get nothing since the stock price goes down accordingly. How is this different from a stock buyback besides taxes? Okay, so I would say, and the thing is, like, strongman and I, we can disagree on things, and on different nuances, and there's absolutely nothing wrong with that, right? So we already disagree on some things, and we just provide different perspectives. And I understand exactly where he's coming from with that with this comment, and it's a very valid comment when you really get down to it in terms of the tax efficiency of dividends, because the dismissing of dividends comes from the tax inefficiency mainly. That's what, when we've talked about it, it's the main point of contention. It's not so much that it goes down afterwards, because that's kind of like a little bit rudimentary, because it goes down afterwards to reflect it because of how the market works in terms of arbitrage. There's no such thing as arbitrage is basically eliminated in the modern day. Back in the olden days, you could have done that, but arbitrage in the modern days more or less eliminated because information is so rapid, technology is so good, and so that level of dividend arbitrage is no longer available. So that's why it does go down like that. So you have to have the best technology or the best bot to do it for you. But that's not what you're asking. But specifically with the taxation part, and also understand the context, Strongman Personal Finance, he's a CPA, which, by the way, I will have my CPA as well soon. But for CPAs, in terms of taxation training, I want to find the most strategically the most tax advantageous way to make money, right? And dividends can be a poor way of doing that unless in a tax advantage account, and then you don't really care. But there's an added nuance to it because there's a thing about buybacks having a certain assumption, and the presumption is, and I'll say this here, and this is actually where I mentioned this in other videos before, the presumption of buybacks being better is that they're executed better. And that's difficult. That's actually really difficult to determine. And in fact, that's why statistically over long periods of time, a lot of the returns has actually been through dividends from companies, because basically a dividend takes money off the table. So it removes the volatility aspect. And then that's why mathematically over time, it does make sense when you really break it down, why so much of the returns has been through dividends, and buybacks can actually be very destructive, right? So there's nuance to it, right? There's nuance with everything. Buybacks are better when executed properly. So like Berkshire Hathaway is a good example of well-executed buybacks. They haven't paid a dividend yet thus far, but well-executed buybacks, because you listen to Buffett and Charlie Munger, they'll do buybacks strategically. So they'll do buybacks when they have nothing else to invest in and when they feel that Berkshire Hathaway is at a good price. There's a lot of companies that do buybacks just for the hell of it. They're like, oh, I have money, buyback, right? Instead of dividend, buyback. And so that doesn't necessarily exactly return value to shareholders, because just as for those who stay, for the investors who stay, just as that capital has been returned to you, it could be just as easily destroyed by the whims of the market. So let's say this happens all the time. Like we can measure this, where we call wasteful buybacks. A company buys back a ton of shares and then the stock collapses. Great example is IBM. IBM had both dividends and buybacks, but what was very destructive to the value of the company was the buybacks. Right? They, on top of the buybacks that were destructive, they were multiplier of destructive to the company because they took on debt for the buybacks. So that's the worst time. So when you take on debt to perform terribly executed buybacks, you have a recipe for disaster, and the value of that business will fall drastically. Because think of it like this: I have $1, and so I could give you the dollar right now, or I could, in theory, speculate and buy the asset, the stock back for that dollar. Instead, I don't give you the dollar directly. I give the dollar to someone else and delete the share. Now you think, okay, over time I own more of the company. But what happens if I bought for a very expensive price? So that's why I say sometimes, I should be highlighting this more, but I did highlight it in older videos. I just kind of like assume it, but I need to remember there's always new subscribers. So I need to, repeat some information. That what I look for when I see buybacks is that if the company is selling at what I believe to be an attractive price, I agree with management's allocation of capital. I'll be like, all right, if I'm willing to buy it, then yeah, I'd probably agree with the buyback. If I'm not willing to buy it, I probably would say a buyback is destructive, right, in terms of value. So then that's the added nuance that I think is lost in the conversation, that yes, buybacks are better when executed. If they're not executed, then we're changing the conversation. We're changing the terms of the conversation. A poorly executed buyback is extremely much worse than a dividend. Okay, but again, the premise is that on the surface, dividends are less tax efficient than a buyback because they get taxed and you get double taxed. And that's actually gets into the conversation of people thinking that the capital gains rate is so low, and they don't agree with it for dividends. They think it should be higher. But then, when you add the taxes up, you end up having a crazy amount. So let's say your tax dividend rate at 40%, the company's already paying at 21%. So you have to actually consider that into the tax calculation. When you get a dividend, and let's say you're at the highest tax bracket, you're getting taxed about 40% at the minimum. Some states will tax you on top of that, but you're already getting taxed a lot. That's higher than the highest income tax bracket. So yeah, it's not like, it is not free money, right? It is money that exits the company and the company's returning to. However, with nuance, we understand it a little bit differently. It's like taking money off the table and removing the volatility from it. $1 in your pocket is no longer in the same volatility. That's the equivalent of like saying, I'm going to reinvest the dividend, right? By reinvesting the dividend, you are essentially making a statement. You are saying that I believe it's still undervalued, and this dividend money, instead of going elsewhere, I'm going to put it back into the same asset that provided it. And then so you're continuing the speculation, so to speak. Okay, so that was a long answer to maybe a shorter question, but I hope that answered that question. All right. So since you're from Venezuela, do you have any practical personal finance advice to protect yourself from government becoming abusive? See, okay, this is where I say that I don't hold any crypto assets per se, but I cheer them on, because if you understand also what happened to Venezuelans is Venezuelans even now are using crypto assets, specifically Bitcoin, to transfer money out. And philosophically, in a decentralized currency environment, it becomes a lot harder for tyrannical rule. And so, of course, governments do not want that, because it actually is a threat to their overall power. So in that sense, gold is also decentralized. I get down to like the crux of it. And I have a video where I talk about Bitcoin. I said, don't be surprised if it wins, but I don't know if it will win. Some people thought I'm being very bullish on Bitcoin. If I was bullish on Bitcoin, I'd own Bitcoin. It's kind of like I just don't know, but I'm on the sidelines and I'm cheering for it, right? I hope something like it wins, and then we can have some sort of safe store of value that someone could permanently save into. And, like we get into like more of the deeper, wider discussions of, how in the past people could just save and retire from their savings. And now in the modern day, people, in order to retire, have to actually take on risk, which is actually rather unfortunate, because not everyone wants to take on risk. Not everyone has the mental fortitude to take on risk. And then why should they be forced to necessarily? Well, it's because the overall value is there's a added difficulty of capturing value, right? And capturing value is maintaining value over time. And so you have that difficulty for various reasons. But something that is a sound currency could serve that purpose of maintaining value. And then you don't have to necessarily work your whole life and take on risk to only just, retire at the bad moment and then, lose a lot of value, because stocks go up over the long term. But like, what happens if you were retiring in 2008? Like you retired in 2008, or you got let go and you had an early retirement in 2008. That's the person who was shafted, not the young guy. The young guy who went through 2008 is fine. It's the older guy that retired right on 2008, and let's say they had 100% in stocks. And they don't have millions of dollars, so they actually need the money, the capital, and they can't live off of the dividends to actually pay for bills. So they actually have to sell, and so they're in a bad pickle. All right, so those are the people that really got shafted by capacity. But yeah, gold, for example, in its philosophical sense, is money that no one else can control. Like, only, let's say for argument's sake, only not to say it's religious or anything, but only God can change the rules of gold, which is a phrase to say that it doesn't matter what you want gold to be or what I want gold to be. Gold is gold, and if I hold gold and you hold gold, we both hold gold, and no one else can say, well, that's not gold. Well, no, gold is gold, and gold is gold anywhere in the universe. So that uniqueness, that ability for no one to change the rules is very important. I actually discussed that in the Bitcoin video, which is why a lot of the cryptos, I think, inherently are absolutely worthless, because the rules can be changed, and that makes them worthless at the end of the day. And I have an interesting perspective, I guess, on regulation. I think regulation is kind of like the opposite of what you want. If you're a crypto guy. All right, anyway. Which curve do you look at? Tens, twos, tens, for how long does it need to? For a couple, I think it's like, technically on an academic standpoint, I think it's like 3 weeks. Yeah, 3 weeks. You need to see an inversion. I think. I don't quote me on that, but it's a sustained inversion. That's what it has to be, a sustained inversion. Okay, we have a 1 out of 2 questions. All right, hot take on AMD. I don't believe AMD's real value is in gaming PCs. I absolutely agree with you. I believe it would be an infrastructure because the competitive power advantage. Absolutely agree with you. Absolutely agree with you. Oh my gosh. Underrated comment. Not everyone, because clearly you don't, and a lot of people don't, and a lot of people in this comment section probably don't. A lot of people think that AMD's value is in the gaming PCs. And then, you see like what's going on in gaming PCs. I just bought a new gaming PC. It's actually downstairs now, right? I actually got to bring it up to install it. But inside of it, I didn't choose AMD. I chose NVIDIA and Intel, right? Because at the time when I was measuring the performance for what I needed to do, Intel was better and NVIDIA was better than AMD. But that doesn't mean AMD is worthless. Like that's the surface level analysis going like, oh, I didn't buy it and I don't see anyone else buying it. Therefore, it's a bad stock, or therefore it's a good stock because I bought it. What AMD is basically providing is an alternative to Intel at a cost efficient on a commercial basis, which is where the real money's at, not the consumer facing end. The consumer facing end is all of us. We don't really matter. But yeah. And then two, against Intel and the fact that Azure and other smaller infra providers is not building their own CPU, unlike other players, and said AMD is a that said AMD is a YouTube. Oh, I didn't know it was a YouTube stock. I wouldn't really consider that a YouTube stock. I mean, I'm not trying to poo-poo on YouTube stocks, right? Just because it's mentioned here on YouTube doesn't mean it's a bad company, right? That's a not a good connection to make. We have to take every argument in isolation. Just because someone says something and I don't like that someone doesn't mean it's wrong. Just because I like someone and they say something doesn't mean it's right. Okay. So, yeah. I mean, so I want to say that if anyone perceives that from me, I don't think YouTube stocks are wrong. I just think it would be interesting to kind of create a ETF on YouTube stocks. Are there any individual cybersecurity stocks you like, or would you rather just go to an ETF route with them? Okay, so business wise, what's Fortinet? I loved Fortinet. I had an involvement with Fortinet. I no longer hold Fortinet. I like Fortinet. They had a huge run. CrowdStrike is everyone's favorite for obvious reasons. It's not like it's not deserved. It's deserved, but the valuations is terrible. You have Splunk. I liked. I was going to do a video on Splunk, and then it rose up. So I was like, all right, my video is going to be worthless now because it went up. so I put it in the back burner, but I was going to do a video on Splunk. I did a video on Checkpoint, and Checkpoint during that liquidity crunch era was actually the only one that did go up. I wasn't the only one who did a video on Checkpoint. I make it sound like that, but no, I did a video on Checkpoint, and I liked Checkpoint based on the valuation. It didn't really need to grow much in order for the investment to be favorable. A lot of people didn't understand that when I made the video. So because conceptually you think that everything has to always grow, and not necessarily. Depending on what price you're getting for something, you could actually factor in a decay or stagnation and still actually come out on top. Checkpoint was one of those because they're a cannibalizer. They're in essence, they're buying back where I think they should be buying back while the stock is very cheap. All right. I like your thank you. I recommend also adding a secondary sort of descending allocation percentage. Okay. So yeah, so it's currently so what Zastar is saying is currently the portfolio that's everyone can see. There's a link on any of the videos where I talk about the portfolio. It's currently organized by strategy. So then it's easy for someone to glance over it and quickly see like, okay, these are what Fabio is like currently like buying. These are what he's not buying, and these are what he's selling. These are what he sold. And by the way, I will always keep all my sold positions on the portfolio for now, because it's not a nightmare to like logistically manage that. But for now, I'm just going to keep all of them. So they just stay there. So you can see things I've been involved in the past up to the publishing of this. I'm not going backwards in time and putting all the stocks I've ever bought. So, but yeah. Okay. So the thing, Andrew, is that it's so easy to get better from the dirt. That's where Venezuela was. We were like quite literally in the dirt. So now we had the population, a huge portion of the population is gone. So we have a smaller population base. A lot of money is coming in because a lot of people go work outside and then they bring money in. So a lot of these factors are improving, but again, we're improving off of like a terrible base. How did I get into the United States? No, I'm kidding. I was going to say from the board. No, I flew into the United States. I was actually lucky enough to be born with dual citizenship because my mother was an American citizen already. So my mother was an American citizen, legally speaking. She was born in Venezuela as well, but she was already an American citizen. And so I was a naturalized citizen. So it wasn't a big deal. My father was the one who had to become a citizen. Airbnb, interesting business. If you believe that everyone's going to go out like crazy and that play, I think they're very interesting. There are plays that will probably perform better, such as for example, the ones that are really poo-pooed on a little bit are the cruise liners. I already made a video about the cruise liners, how they had a lot of permanent destruction to the balance sheets. And I did, I mean, I literally meant that literally balance sheets, because it's multiple companies, not balance sheets as in the financial statements. But the they have more to gain. So oftentimes when you have very depressed companies, the ones that have more to gain from a situation are the ones that obviously have more to gain in terms of stock price too. So what do you think about regulation risk of pharma companies? Not a big deal. Not a big deal. For a variety of reasons. No one's going to really like shoot down the capacity for them to produce medicines into the future. So not really a big deal. I think that's just more noise than anything. Fun fact, Bonson Home trying to take it from Bomb. Yes. That's why. That is why. Thank you, Alex. Yeah, I knew that they were going to do it at some point. I didn't know that it happened already. Yes. But it makes more sense for them to be Boston Omaha Corporation instead of Bauman. BOC sounds better than BOM. Bauman. I thought it was Bank of China, because that's the ticker still. Bank of China is BOC. So I was like, why am I getting asked this Bank of China question? That's so funny. All right. So is your site? Yes, the site is down. The site was originally hosted on GoDaddy, and now it's being built from the ground up. So I've been asked that a couple times. I even get emails, and I always respond to the email saying, "Oh yeah, it's down because we're building it from the ground up. We don't want to host it on GoDaddy. Too limiting to host it on a third party. It's best just to build it from the ground up." And so yes, yeah, I think I would put a description in every video from now on saying that it is down. So because I get a lot of that. How you doing, YouTube user? Inconspicuous. Is it looking good? Okay, because I was gonna just shave the whole thing. Again, for context, anyone joining, I cut my own hair. Okay, so when you're going to do a video on CPANG, SE, and Melly, oh, C Limited, I got to do a video on that one. I like that business. There's a lot of risk. Coupang, that's the Korean Amazon, I think, and then Melly I like Melly a lot, but Melly, it's the valuation. I just like the business. Okay, when I say I like a business, try to separate my words, and I'm not saying that I like the stock. I just like the business. All right. When a company like Tesla decides to split, are they signaling that they admit they're trading on perception more than fundamentals? Are there legitimate reasons to split a stock? Yes, there are legitimate reasons to split a stock. Liquidity, specifically put, liquidity. So, one, it allows because technically now we have fractional shares, but a lot of brokers still don't allow you to sell fractional shares, just buy fractional shares. So when you have, like, let's say you have $1,000 into a stock. Let's say I have 10 shares of Tesla. That's $10,000. Let's say I only want to sell $100 worth of stock. How do I do that if every stock is worth $1,000? So by doing a split, I actually provide greater liquidity to my investor base. So I can allow them to kind of just nibble off a little bit of shares. And so it does actually reward shareholders who have been with you for a long time. However, just like how Warren Buffett's kind of talked about it, it does incentivize a greater behavior of trading. So like people are less likely to trade a stock that's worth $10,000, right? You're not really going to sell a stock worth $10,000. Unless you're looking to sell it, right? You're not looking to, I'm going to take off some. It's less incentivized. So your shares of Berkshire Hathaway, $300,000 or $400,000, BRKA is less likely to have a lot of trading going on. It incentivizes holders to just hold for the very, very long term. Of course, the drawback is lower liquidity. That's what BRKB is for, increased liquidity. So you can have the same exact exposure to the economic benefits of Berkshire Hathaway in proportion to the amount that they represent, but you have greater liquidity with BRKB. Okay, so yes, yeah. So it's the tax argument, and then the assumption on buybacks being better is their execution. No, I do not hold a CFA, Licks. If I did, you guys would actually be able to look me up and be like, hey, he has a CFA. Thanks for explaining AYX. Got to your point. That makes even more curious about your view on Viva. Oh, I love Viva. All right. So yes. Viva is a great example of that. Viva is actually built off of the Salesforce platform. So the only risk I see is really Salesforce, but they partner a lot with Salesforce. So Viva is a great example of a high switching cost business. Great example. The benefit of buybacks is that you as a shareholder, that's the main benefit of the buybacks again. But like, as far as like it being better, absolutely, in an absolute term, no. Nuance is execution. If it's executed poorly, it's very destructive. You might as well just burn money. if you execute poorly. Yes. Oh, yeah. Oh, okay. I think I already answered your question, but yeah, I definitely own. I not own. I know Vive. I love that company. I don't own it, but I do like it. What do you think about the company? Oh, I had. Okay, so I have talked about HPQ and HPE in one video, and I compared them both. My conclusion at the end of the video was they were both extremely cheap. I haven't actually seen how they've been performing, so I'll actually look that up right now. But my conclusion, before I look it up, my conclusion was they were extremely cheap, and they were priced for something terrible, and if something terrible never happened, they would perform pretty well. All right, so let me which one should I look first? I think HPE is the enterprise, and then HPQ is the printer. So HPQ was extremely cheap, if I remember correctly. HPQ, okay, so it's at 30, it's down 5% today. Okay, no, it's performed well, I think, since the video. I think I did the video in like October or November, around there. So it's performed okay. It's actually gone up in price like 20%, something like that. And let me see HPE. HPE, it's done like the same, maybe a little better. Yeah, I can't really. No, sorry, I'm looking at the wrong year. I'm looking at March. No, no. It's done not as good, but somewhere in the same ballpark. Okay, so they've done pretty well. So they turned out. I didn't invest in them, so I didn't participate in that, but um, that's, again, I'll do videos on anything you guys really ask for in terms of subscriber requests. I'll give my opinion, and then that if I don't own it, I'm giving you an unbiased opinion. And so with that one, I gave I think my unbiased opinion that they were cheap. Taking debt to buy back your own stock sounds like the Federal Reserve. Yeah, it does. I was late to the live stream and I'm watching at 2xp to catch up. Just want to say thanks for the. Oh, of course, I love doing them. Dead money. I'm not going to lie. I'm sick of crypto pumpers, and I pray every night before I go to sleep that Bitcoin goes to zero. Crypto pumpers are worse than the tyrannical government. Okay, so I understand yes, because they're pretty much like annoying, right? Yeah, and then tyrannical dictatorship, man, I can deal with. That's funny. I can deal with tyrannical dictatorship. All right. Do you think interest rates will ever be high enough to make savings accounts worth using, say 4%? Nah, man, you just use Voyager. Use a Voyager account. There's nothing wrong with that. I'm just, I'm clearly being sarcastic. I was going to say this for the Voyager video, but yeah, just there. Think about it. How are you getting high interest rates in a low interest rate environment? How do you think they're managing that? All right. Your valuation of Thor is good, but why not wait for post-COVID sell-off or reaction before buying? Because I don't know if it will happen. That's an easy question to answer. Like, if I suspect that there might be a possibility, that enters into like the art side of me allocating capital. So I might be like, oh, I would allocate this much, but because I'm not really sure about this, I'm going to allocate a little bit less. Right. So that's how I handle that. I don't try, again, like I'm consistent here. I don't try to time the market. I'm not going, oh, I think there's a sell-off coming, therefore I'm going to do entirely this. No, I look for assets that I like. I like the story, I understand the business, and then I evaluate them in isolation. And part of my beliefs about what might be going on in the macro sense might affect my valuation in terms of what I make in projections. And then that dictates the prices I'm willing to pay for. And then in that, I can add a little flavor of, in the allocation portion of my decision making, I decide maybe I allocate a little bit less to that position than I would otherwise do if I wasn't so, not terrified, but concerned about some aspects, right? And in that valuation, I felt like I was being very bearish on Thor. I thought I was being like, oh, it's priced for this, you got to be careful of this and that and this and that. And because I try to focus a lot on the risks. All right. Yeah, I know. I have a lot of friends who actually live in Portugal, funnily enough. And they tell me a lot about the struggles about being over there, the opportunities or the lack thereof, right? What was the name of the free course on YouTube that was mentioned by one of the subscribers? Can't find. Oh, it's okay. So there's a professor in NYU. I can't pronounce his name. Just look up the Father Valuation. I think that's what his name is called. Just look up his name in like a Google, and then he teaches at NYU. He's a Indian guy, Indian or Pakistani, somewhere around there in that region. And just look up his name on YouTube and then valuation course, and then that should pop up. That should be like that's a good free resource. So I'm happy that exists, and I hope to add to that in that capacity. Thoughts on companies that moving to domestic manufacturing because China concerns? Great. I mean, whatever improves the supply chain, whatever streamlines the business operations. I think that if they move domestically, it will be in a more automated fashion rather than, traditional manufacturing and the like. So, it's not going to be like big factories everywhere, lots of jobs and stuff like that. It'll be like a little bit more nuanced. Like, well, it depends. Like, what is it going on? And then some might not be going here, but just changing out of China. So, okay, what do you think about the arguments that index investing, specifically in the U.S., can give you nothing over several decades, like Japan? Sven Carlin seems to be very against dividend investing. All right, Sven Carlin seems to be very against dividend investing. That's interesting because he also acknowledges that, or I saw a video that he acknowledged that dividends. And I say this like I'm not a dividend investor, but I don't also disacknowledge that fact, right? That fact being that a huge portion of returns over long periods of time is dividends. And then when you break down the math, it makes sense because you're removing volatility from the equation, et cetera, or removing volatility in that aspect of the equation. And for the first part of the question, what do you think about the arguments that in the U.S. can give you nothing over several decades? Okay, I actually use that argument quite a lot, right? And so then that makes the argument why, for example, that's why Strongman Personal Finance comes in, and his argument with VT is very solid in that capacity, right? So he'll tell you his answer to that, and I won't put words in his mouth, but you can ask him this exact question. I suppose that what he will say to you is that's why a product like VT is desirable. While in some years it's going to underperform the U.S. market, you will have that exposure to the foreign markets where that will make up for in times when the U.S. market will come down. Now, nuance to that. Right now, at the present moment, the quantity or the portion of VT that is US is drastic. It's insane. So right now, VT is almost equivalent to a US index, but because the design of these indexes are market cap weighted indexes. And then there's reasons as to why they're designed that way, but that's how they're designed. But yeah, interesting to note that that Sven, I guess more recently, is completely against dividends. I think, okay, here's where I would say dividend only investing can be debilitating to long-term returns because you're going to avoid a whole host of companies that are fantastic. And just because a company's not paying you a dividend now doesn't mean it won't in the future. So, and here we go with the out of focus. So let's say like Google, right? Google doesn't pay a dividend. It used to not do buybacks. So if you bought Google when it IPO'd and you held it the whole way through, we didn't get capital returns until recently, but now we are getting capital returns. Okay, so like think of the yield on cost. Had someone bought Google in the past, the yield on cost on capital returns, like buybacks, and then let's say they pay a dividend. What will that dividend yield be on the yield on cost of what they paid for in the past? So that's why I would say I would completely agree if the statement is more nuanced and says, only focusing on dividends can be debilitating to long-term performance, because there are plenty of stocks that are dividend stocks like Apple, Microsoft, that have performed very well above the market average. And so, I won't say like with a definitive fact that if you focus only on dividend investing, you will underperform. That's also not true. But it can open yourself up to that. Okay. If you can't tell, I am a person that doesn't really believe that there's an absolute answer. It's everything, every little thing is nuanced, depends. What are we talking about? What are all the factors? I always ask someone when they ask me a question, and it's like when I have to assume factors, I start to ask like, okay, well, what are these factors? I don't like to assume. All right, thoughts on semiconductor space as a whole? All of it, I mean, maybe broadly diversifying in semis is a decent idea. Maybe I haven't really put much thought into that, but the whole sector, I think you don't have to be a genius to identify that is the future. I love that. I'm actually, here's to add to your thesis. I'm probably going to purchase the premium subscription for Capital Mindset, for the business Capital Mindset, a premium Zoom. Therefore, 50% of Capital Mindset's portfolio will go into Zoom because I'm investing in it. In a DCF projecting out 5 years, do you think I'm getting another text message? Who's this? Oh, it's a voicemail. All right, cool. I'll answer that in a second. In a DCF projection out 5 years, do you think that it makes sense to subtract the entire outstanding debt from the terminal value, or only debt payable leading up to the end of the forecast period. Okay, what are you assuming in that calculation essentially? Because okay, so let me read it again because maybe I'm not understanding. Do you think it makes sense to subtract the entire outstanding debt from the terminal value, or only the debt payable? Oh, I see, because the debt is retired. All right. Well, the debt I would say you're assuming debt is going to be retired and not rolled over. So a lot of companies roll over debt. That would be an extra assumption. And the more assumptions we make in our valuations, the wider the confidence curve, or not the confidence curve, the confidence interval becomes. We become less confident. All right. So, what do you think about the sector rotation strategy? No, I don't. Do that. But I hear that you can use it to beat the index, especially if you do a tax advantage account. Yeah. Okay. So if you can execute well, sure. Yeah. In a tax advantage account, absolutely. That's actually key because you don't want to get shafted on that. Um, oh, another video on this one. Another video. That's such a long. The Snyder pill. I talk about the Snyder pill a lot. All right. Direct listing if you can get a good price. Let me go like a speed round. That's funny. Okay, that's funny, you guys. How much returns of stocks is just from the asset class industry? The stocks 2020, you did well. If you bought tech, even better. Oh, I don't think that's for me. Is that how much returns from stocks is just from the asset class? I sorry, Apollo. I actually don't understand the question. My brain's just, I guess, not working. Yep, there he is. That's the name of the guy, guys. Okay, so you guys were answering questions down here. Would you be bro score? Yeah, I would buy his course. Level of confidence about Netflix investment is. By the way, guys, I'm gonna have to start wrapping this up because I do have to get back to doing stuff. But let me just answer all your questions here. Your level of confidence about your Netflix investment want to be successful once the free cash flow could very well be low for a while. Yeah, it could be very low for a while. But the thing is, you don't want to punish a company for having growth capex or growth investing cash flows. So that was a big mistake people made with the valuation of Amazon, right? The cash flows look negative, but you were basically subtracting out growth capex. Growth capex needs to be taken into account as something that is not necessarily a negative, right? Okay. All right. Let me see this. What steps? Okay, so as well. Okay, so that's more of that. What steps do you need to take to deceive model to not punish a company for growth capex? You have to subtract growth capex. A dirty way of doing that is taking a look at depreciation. What is Sven calling? I mean, Sven Collins. Oh, okay. He's against index investing. Okay, well, he's against index investing because of the very reason that there's a couple reasons as to why, but I take those arguments into isolation and kind of think about them in isolation. Okay, I have gold and silver, physical gold and silver, not paper gold and silver, but I don't do it as like an investment. I do it actually like as a collection for fun. Small Gabriel apparently had a chance. I mean, yeah, I mean, maybe he did. I don't know if he's extremely high net worth individual and really did. Don't you feel that your investment manager could or was very influenced by your previous ownership of the company for failed acquisition? Absolutely, absolutely. I do take that into account. And my answer is, it's a small portion of the portfolio. I took a look at like basically what it is that I own. I do think it's a strong acquisition target. They also own a lot of assets in terms of real estate that actually could be spun off and in a lot of ways could probably, if not provide more value than the entire market cap of the company, but we'll have to actually see. What value would you allocate? See, if I'm going like super fast, I'm trying to answer everyone's question. How much portfolio value would you allocate to a very good, unprofitable business that dominates in its marketplace and it will be for the next 10 years trading at an okay valuation? Depends on the industry. Nuance depends on the industry and stuff. Do you think you can outperform the market? Is if your whole portfolio is in the whole market? You think about it, you cannot underperform the market. Yeah, exactly. That's the idea. I have a video on Starbucks. I will do a video on Starbucks. That is actually on the list, but it's a little further down. Adobe feels very expensive. It is very expensive. Well, it's not too super expensive, but it is expensive. Consequently, it feels a lot more risky than Facebook, for example. However, you're kind of used a lower margin of safety for that one because of the moat. Yes. I think actually Adobe has a little bit stronger moat on a B2B scale, and actually they're taking like market share away from something like a DocuSign, and then you also have HelloSign coming in from Dropbox, which I also own Dropbox. But yeah, Adobe has a stronger moat in B2B. Facebook's coming for B2B. Don't worry, they're going to get there. That's what the metaverse really is. So what I mean, if you're just buying a specific asset class and industry, already captures most gains. This is a company doesn't matter that much. Yeah, I mean, yeah. Like for example, I had a commodity play, and I'm kind of getting out of the commodities play right now. I'm still getting out of it, trying to sell. Thanks for the video. What time do we expect? Okay, so I'll deviate because sometimes they're better for other people, and so I'll deviate. I'm doing always 2 live streams a week. I try to. So there's actually be one tomorrow with a guest speaker. Investing Sucks. I have to actually email him to confirm. You guys might know him as well. He's a Canadian investor, does videos as well. He has a YouTube channel. He's going to come on. We're going to have a discussion, and that was going to be, I think that's around 7 tomorrow. So check out Friday, and then this is making up for my missing Tuesday's live stream. The most underperformed U.S. stocks, in your opinion, not a financial advice. The most underperformed U.S. stocks, the most underperformed, the ones that will underperform the most. High debt, high debt, low growth stocks. How about that? Cop out answer. I have a video on LYB already. Do you have any pets? I have 2 cats. Okay, since you collect gold and silver for fun, do you have? And by the way, it's because low maintenance. Dogs are higher maintenance. Okay, so you collect gold and silver. I want a dog though. I will have a dog one day. Do you mainly? I have some coins. I have also some rounds in gold and silver. Next one on your right is not your aligned. It triggers my. I know. No. Most of the time, I'm gonna have the green screen in the back from now on. I'm too lazy to fix that. I have to tear it all down and redo it. I am so sorry. I understand. And I have a lot of friends with OCD. They come in here, they're like, I can't stand that, please. And I'm like, I'm sorry. All right. Logan, okay, I'll add that to the list. I haven't actually been requested J&J yet. So, okay, I meant was undervalued US stocks in your opinion. Most undervalued. Okay, so, wow, on the spot. That's why I like these live streams. You guys ask me a question, I got to think on the spot. Okay, beaten down profitable tech with lots of fear, right? But obviously I think that, right? Obviously I think that because I'm buying it. Okay, that's what you have to put an asterisk there. It's like Fabio is very biased with this answer because he is buying it. Obviously, if I think it's undervalued, that's the stocks I'd be buying, right? It'd be crazy if I said, oh, not those stocks. I'm buying them. That'd be really funny. Video. Yes, the thing is, it's a very difficult video to do. Very difficult business to do a video on. That's why it's taking so long, and it's kind of taking a back burner because a lot of work stuff. So, what do you think about holding? And I don't want to throw out like a half-assed video. I want to when I do a video, I want to do a good video. All right. So, what do you think about? I don't hold any precious stones, but I'm not. I don't understand it. I have to understand more of it before I even think about it. Consider making a shorter video sometimes. Also, take in mind that we're watching you at 2x speed. Oh, have I talked too fast? Yeah. Okay. So I'll talk like this. That way you guys can watch me at 2x speed. The videos become 40 minutes long. They used to be longer because I would talk slower. And then I learned how to talk faster, but still not stutter and get the information out there. I do have some shorter videos. More recently, I've actually produced a lot of shorter videos, but long, short. It just depends on what I'm covering that day. Love your content. Thank you. I'm really happy to hear that. But I would like that you would be gone more in depth in the video of Mesa. Okay. Yeah. So okay, so specifically, what would you like me to go into more detail on? And then I can probably do a redo of that video. Needs a pause according to, all right. Analysts are infallible. You should not question analysts, Torre. Analysts are infallible. They don't make mistakes. They are infallible. Okay. Don't question them. If I see that language out of you one more time, I'm putting you in the penalty box. All right. If you question our beloved analysts, I'm going to create, by the way, for comedy. Let me know what you guys think. It's going to be a new show, and it's going to be called Frat Boy Finance. Not to make fun of people in frats, not anything against them, but just like for comedic relief. In which case it will be like a rival show to this one, and eventually it might, if it becomes something, it might branch off into like its own YouTube channel. And then it'll be funny if it grows way faster than Capital Mindset, and it's going to be talking about stocks, and quite literally a lot of the analysis will just be looking at Yahoo Finance. But let me know if that's something interesting or it absolutely sounds stupid. All right, like to know your guys' feedback. I have some friends who were in frats, and they're going to help a lot with the show. And I have like the background. It's like a frat house. It's going to be on the green screen. It's going to be great if I do it. I think it's funny, you know. What should be beaten down? Profitable tech company? Netflix, Facebook, those kinds of companies. My portfolio is public. You can just like glance at all the ones I'm accumulating. Obviously, I think those are, cheap. Yep. I'm sorry. I only made 300% returns. Yeah. Since analysts said, that's the thing about analysts. All right. And I'll finish off the stuff that it was wrong with that company because I salivate with a company so freaking cheap. I can't hold myself. I am a little bit on it. Yeah, you can definitely do that. I mean, like you can gamble on a company that's really cheap if it's like a value, but be careful, it's a value trap. And that's, I think, one of the concerns I had with Mesa. There were a lot of aspects of the business that kind of concerned me, if I remember correctly. I sound like a douchebag there. No, you don't sound like a douchebag. I know what you meant. Futureman Stocks loves Yahoo Finance. Is that a YouTube channel? Oh my gosh. No. Like I have the hat backwards. Like I have it all planned out. I have the vernacular that I'm going to use. It's going to be completely different kind of vernacular. It'll be a test of my acting skills. I'm not really an actor. We'll see if I'm good. Yeah, I know. I'm trying to get through all the questions really quick because then I have to go. It's only going to be like an hour and a half live stream, and then I got to get back. Tattoo Chef is a hidden gem. Let's just say his name is going to be Brody, is the character, and Brody likes his vegan food. Or his vegan investing food. All right. On that note, guys, thank you guys so much for coming tonight, or not tonight, but whatever time you guys are in. If it is night for you guys, thank you so much for coming tonight. If it's morning, thank you. Good morning. And if it's afternoon, good afternoon. LD, I'm sorry, but come tomorrow at 7:00. I have a live stream with another YouTuber, and then you can ask questions there. But thank you guys so much for coming. I really enjoy these with you guys, and I'll see you guys on the next one. So have a good one. Bye. William Brown, any video where you see I have portfolio update titled or portfolio review, any of those, it's in the link. It's a Google sheet, and just go on the channel and explore the videos there. All right. I'll see you guys in the next one. Have a good one. Bye.